Well, hello everyone. My name is Elliot Yu. I'm founder and editor of Smart Bonds, and today I want to address a common question I've been receiving from readers over the last few months, and that regards the Fallen Angels exchange traded fund that I recommend in the Smart Bond service. Now, some of you might not be familiar with the term Fallen Angels, but you're probably familiar with investment grade versus junk bonds or high yield bonds. So investment grade corporate bonds are bonds issued by companies with higher credit ratings, usually defined as sort of BBB or higher. And high yield bonds, which we used to call junk bonds, some people still do, I find myself doing that quite regularly, have below investment grade credit ratings. So they have, they're shakier credit quality. Now, Fallen Angels are a subset of the high yield bond market. These are bonds issued by companies that used to be rated investment grade, but have fallen to junk categories or a high yield bond category. So the credit rating has fallen below that BBB level. So most Fallen Angel bonds, as I'll explain in a little while, are in that highest category of high yield bond or junk bonds, which is the BB sort of range. So the questions I've been receiving range from, why do I recommend high yield bonds at all? What's the benefit there? Aren't these shaky credits? Aren't these risky? I've had questions specifically about what's the risk in the high yield bond market versus, say, the stock market or treasury bonds, which I'll get to in a minute, or high dividend or dividend-paying securities as opposed to bonds, actual equities. So I want to address those points. I've also gotten the question quite a lot recently, why high yield bonds? Why Fallen Angels rather than just straight high yield bonds? So there are ETFs that track specifically the Fallen Angels segment of the high yield bond market, and there are some ETFs out there, several, that track the broader junk bond market or high yield bond market. And a couple of readers have even pointed out that year to date, the straight high yield bonds have actually been outperforming the Fallen Angels a little bit. So the Fallen Angels ETF that I recommend, which I'll talk about specifically what it is here in just a minute, including the symbol and everything, that is up about 4.14% year to date here in 2025. The largest junk bond ETF, or one of the two largest junk bond ETFs, the one that's better performing, well, that's up about 4.71% year to date. So why do I still recommend Fallen Angels rather than just broader high yield bonds? So let's start with just the simplest possible chart that I'm going to throw up on your screen right now. This is the total returns, okay? This is the returns from price appreciation, capital gains, as well as cumulative distributions for 4 different exchange traded funds that are income oriented, trading here in the United States. So the FALN fund, this is the red line on your chart on your screen. That is the iShares Fallen Angels ETF. That is actually the Fallen Angels ETF that I recommend in the Smart Bonds portfolio. That's the one. The DVY, which is in blue on your screen, that light blue color, that is the iShares Select Dividend ETF. This is a very popular ETF that I get questions about a lot, and it doesn't invest in bonds at all. This is an ETF that invests in stocks that pay above average dividends. So large cap US stocks that pay above average dividends. A very popular income oriented ETF. As I'll show you in a minute why it's not my favorite, but it is a popular ETF that I'm asked about all the time. The AGG ETF, which you see here is in light green, that is the iShares Core US Aggregate Bond ETF. It tracks a Bloomberg index of all sorts of US traded bonds. Everything from treasury bonds, so government bonds, to investment grade corporate bonds, to mortgage-backed bonds, asset-backed bonds of various kinds, just sort of all sorts of US traded bonds. Most of it's in treasuries and investment grade corporate. So it's sort of a benchmark for the performance of the overall US bond market. And I do not actually recommend that one in smart bonds either, but I do use it as a benchmark because it's the most common bond market benchmark out there is the Bloomberg US Aggregate Bond Index, which is closely tracked by this ETF, symbol is AGG. That HYG ETF you see on your screen, which is sort of in that purple color, that darkish purple color, that is the iShares iBoxx High Yield Corporate Bond ETF. It's a very popular ETF that tracks the broader US high yield or junk bond market. And I'm showing the returns here since the end of 2022. So this was right at the beginning of the bull market for the S&P 500, for the stock market. And this is, interest rates were still on their way higher, as I'll show you in a minute. The 10-year yields were still rising at this time. We just came off that awful year, 2022, for both stocks and bonds. Again, I'll show you that specifically in a minute. So this is return since the end of 2022. Now, simply put, just in the simplest terms possible, the Fallen Angels bonds in this ETF, the FALN ETF, has beaten most of these other yield-oriented benchmarks, all of them on my chart. So it's up 27.22%. since the end of 2022. That compares to the straight high yield bond ETF, the HYG, which is up 26.2%. So it's beaten straight high yield bonds by about a little over 1 full percentage point. The iShares Select Dividend ETF, that's a stock ETF, an equity ETF that tracks dividend-paying stocks in the U.S., large cap stocks. That's only up 23.26%. So it's outperformed, the FALN ETF has outperformed that stock-oriented, dividend-oriented ETF by about 4 percentage points since the end of 2022 alone. Completely destroyed that core U.S. aggregate bond ETF, up only 9.57% over this time frame since the end of 2022. Now, another way to look at that, which I think is very worthwhile, is to consider this on an annualized return basis. So the FALN ETF, the Fallen Angels ETF I recommend, it's up over 10% on an annualized basis since the end of 2022. Now, a 10% annualized return is pretty solid. And when you consider that a lot of investors I speak to are under the impression that the bond market has not performed well over the last few years, look at this. FALN ETF has produced a double-digit annualized return, so over 27.2% total return, and it's beaten dividend-paying stocks, this popular DVY ETF that's out there. Now, and a lot of investors I speak to say, why would I invest in bonds when, I can invest in dividend-paying stocks and get higher returns? Well, that has not been the case for many dividend-paying stocks since the end of 2022, as I'll explain in a minute, because that FALN ETF is actually beating the DVY ETF by a comfortable margin of about 4 percentage points. So straight up, simply put, returns from FALN have been higher than straight high yield bonds, the overall bond market, even dividend-paying stocks since the end of 2022. So that's one reason I recommend them. Here's another. This is the current yield on all 4 of those ETFs I just showed you. The current yield on the DVY ETF is a little under 4%, which is not very high. It's a heck of a lot higher than the S&P 500 though. So these are high dividend paying stocks. It's just that there's not a whole lot of yield available in large cap US stocks as a whole in the US right now. Certainly exceptions to that. There are areas I like and other services I run, such as the master limited partnerships and energy, which do offer higher yields and I think significant capital appreciation. But as a whole, the US stock market just doesn't offer a whole lot of yield. The DVY ETF has almost a 4% yield, which is more than twice what the S&P 500 offers. Now, the Bloomberg US Aggregate Bond Index offers about a 4.4% yield, so it's a little higher. But look at the 2 high yield bond ETFs on my chart. The Fallen Angels ETF offers a yield of about 6.56%. That straight iShares iBoxx high yield bond ETF offers a slightly higher yield, 6.57%. So those two are basically equivalent. But you're getting a lot higher yield. This is just the monthly distributions paid by the ETF out of the Fallen Angels ETF and the high yield bond ETF than you are out of high dividend paying stocks and DVY or the broader US aggregate bond index, which yields about 4.4%. You're getting a significantly higher yield, 2 full percentage points higher than the Bloomberg aggregate US bond index, more than 2 full percentage points higher out of the FALN or the HYG ETF. So you're getting a lot higher yields. The other thing to remember is that the bond ETFs that I recommend, almost all of them pay distributions on a monthly basis. So you get distributions from the ETF, the yield if you will, paid out every month. This is an annualized yield, but it is paid out on a monthly basis. For most stock ETFs, it's quarterly. For some, it's actually semi-annual or annually, but for many of them, it's quarterly. So you are getting a monthly check. I know a lot of investors prefer that. Doesn't really matter in terms of the annualized yield, obviously, but a lot of investors find that nice to get a monthly check. So that brings us to the risk side of the equation, the risk. So I've shown you that Fallen Angels offer the highest returns of any of these 4 ETFs, much higher than the dividend-paying stocks in the S&P 500, and much higher than the overall bond market. And they also offer higher yields than the broader bond market or dividend-paying stocks, in large-cap dividend-paying stocks in the U.S. Now let's look at risk. How do we measure risk? Well, one of the most common measures of risk is annualized volatility or annualized standard deviation. And so let's look at that on a historic basis since the end of 2022. The higher the number, the more price fluctuations you have, the higher the risk. The more sort of gut checks you'll get in the form of big sell-offs, the higher the volatility. Volatility for the S&P 500 over this time period has been right around 20% annualized. So let's look at these 4 ETFs. The DVY, which is again is the high yield stock ETF, that has a 15.1% annualized volatility, so less than the S&P 500 over this time frame. Again, all these numbers are reported annualized, but still over 15%. The Fallen Angels ETF has an annualized volatility of about 6.5%, which is less than half the DVY, right? And less than a third of the S&P 500 over this time frame. The HYG and AGG ETF have annualized volatility around 6.3, 6.32%. So roughly the same as FALN. Though, as you see here, the volatility from the Fallen Angels ETF has actually been a little higher than overall Bloomberg Aggregate Bond Index and the iShares iBoxx High Yield Index. And I'll explain why that is in just a minute. Just a little hint, it has to do with duration or interest rate risk. So what you can see here is that the simplest answer to the question, why do I recommend Fallen Angels, is that they provide superior returns with lower risk and higher yields. So in my book, if you can get a higher total return, less price volatility, and you can get a higher yield than, say, dividend-paying stocks in the S&P 500, that's a pretty good investment. 10% annualized return since the end of 2022, also pretty solid in a market that so many investors I talk to think that the bond market's been a terrible investment since the end of the bear market in the S&P 500 in late 2022. Certainly not the case. So let's talk about 2022 specifically, because I think that is a major sticking point for a lot of investors considering investing in bonds or the bond ETFs that we recommend in the Smart Bonds portfolio. Smart Bonds, we only recommend exchange-traded funds that track bond, preferred stock, and credit markets. We do not recommend individual bonds or instruments. These ETFs are things that you can go into your normal brokerage account and buy just like any large cap stock or ETF. So 2022 is a major sticking point because both the bond market and the stock market performed terribly in 2022. Stock market was down, bond market was down. This is very unusual. We really haven't seen that happen where both the bond market and the stock market have fallen together significantly in a calendar year since 1974, which by my calculations is now more than 50 years ago. So both the bond market and the stock market got crushed, and a lot of investors have this idea that the bond market represents safety, right? And the stock market represents risk, and the poor performance of many bond ETFs in 2022 kind of shattered that illusion. So let's take a look at the returns from, on this next slide, some returns from some very commonly held bond ETFs during the calendar year 2022, right? This is the full year return for the whole year, that year, including both distributions paid as well as capital appreciation. The orange bar that you see there is, again, that AGG ETF, the iShares Core US Aggregate Bond ETF, an overall benchmark for the US government bond market. Now in this year, I think the S&P was down 17 or 18%, if I'm not mistaken, for the full calendar year. The iShares Core US Aggregate, that benchmark for the overall US bond market, was down 12.61%. So not quite as bad as the broader S&P 500, but certainly not great. And in many years, the bond market and the ETF and the stock market will move in opposite directions. For example, in 2008, the stock market was down a lot, the bond market was up. So if you had some of your portfolio in bonds, it acted as a hedge. Not so in 2022 when bonds and stocks went down together. And you can see some of the returns from some of these ETFs out there was way worse than the S&P 500. And way worse than the overall US bond market. For example, the iShares 20-year plus Treasury ETF, which buys government bonds with 20 or more years until maturity, that was down more than 30% in 2022. That was more than the stock market that year, almost twice as much as the stock market. The iShares iBoxx investment grade corporate. Now these are corporate bonds issued by companies with lower credit risk. So higher credit ratings or lower credit risk, that was down 17.4%, basically in line with the S&P 500. The iShares 7 to 10 year Treasury bond ETF was down almost 15%, symbol there IEF. I do not recommend that one either in the model portfolio. Now, a lot of investors are surprised though that your riskier or perceived riskier high yield bond market actually outperformed the broader bond market back in 2022. So the iShares iBoxx High Yield Bond ETF that I mentioned a little while ago, symbol there HYG, that was down only 11% in 2022, even though it was investing in riskier bonds, bonds issued by companies with lower credit ratings, higher credit risk. The Fallen Angels ETF was down about 13.8%, so a little worse than the overall bond market. But certainly a lot better than the TLT, the long-term treasuries, or even investment-grade corporate bonds. So, a lot of investors find that puzzling, that I speak to find that puzzling. How did high-yield bonds outperform investment-grade bonds and U.S. government bonds, the supposedly risk-free bonds, right, in 2022? Well, the reason is that there are two major risks you face in the bond market are credit risk, and the U.S. government doesn't have credit risk, or it's perceived not to have credit risk because the U.S. government borrows in U.S. dollars, which can also print, right? So it can't default on its debt because it can print currency to meet its debt obligations. Now, obviously that would cause lots of inflation, lots of turmoil, but theoretically, U.S. government can meet its debt obligations because it prints the currency in which those debts are denominated. However, there's also interest rate risk. And that's a risk that if prevailing interest rates go up, the value of bonds goes down. And so, the U.S. government doesn't have credit risk, and investment grade U.S. corporate bonds have less credit risk, lower credit risk than, say, high yield bonds. But they still can have interest rate risk. So if interest rates go up, if prevailing interest rates go up, then the value of those bonds go down. Now, why is that? Well, think about it. Let's say that you own a bond which was issued in late 2021 and you were getting a 2% yield on that bond. And prevailing interest rates were near zero at the time. But suddenly a year later, in late 2022, the prevailing yields out there are 4% for the same bond. So that 2% bond that you have isn't worth as much because an investor could go out and buy a new bond with a higher yield. So there's an opportunity cost for holding a bond that pays a 2% coupon versus a bond out there that pays a 4% coupon. So in 2022, there was both rising credit risk, and this came because investors were worried about a recession, if you remember in those years, particularly in the autumn. And when there's a recession, it means that bonds issued by shakier companies with lower credit ratings, tend to have a rising risk of default, not being able to meet their debt obligations. So investors demand a higher yield relative to treasury bonds of a similar maturity to hold that high yield debt. So there was rising credit risk in 2022, but the bigger risk, or the more in-your-face risk for much of that year, was the broader rise in long-term, or in broader rise in interest rates across the board. We saw the Fed hiking interest rates at the fastest pace since the early 80s. So investors were mostly worried about rising yields overall, and secondarily, much lower, the rising credit risks, causing them to demand higher returns or higher yields from high yield bonds. So what we see, and I'll show you this here on this next slide, this shows you a measure called duration, which is a measure of interest rate risk. So the higher or longer bond ETF's duration, the more interest rate risk it has, the more risk that it'll go down in price as interest rates rise, or it'll go down in price faster as interest rates rise. So, what you can see here is that in 2022, the bonds that performed the worst tended to be those with the longest or the highest duration. And that's because these had the most interest rate risk. Rates were rising, so bonds like TLT and LQD, even though they have lower credit risk, TLT because it's a US government bond, LQD because it's an investment grade corporate bond, right? They also have higher duration risk or higher interest rate risk because they tend to hold bonds with longer maturities, so more exposure to rising rates. That's why they underperformed so much in 2022. In contrast, look at that pure high yield or junk bond ETF I mentioned, HYG, or a closely related one, JNK, you see there, they have durations of around 3 years. In comparison, the Fallen Angels ETF has a duration of 5.4 years. So one of the reasons why, the main reason why FALN underperformed HYG, or the straight high yield bond ETF in 2022, is the same reason that a ETF like LQD, the investment grade corporate bond ETF, or TLT underperformed HYG in 2022 because they have exposure to slightly longer term bonds with more interest rate risk. So HYG outperformed the Fallen Angels ETF in 2022 and also outperformed long-term treasuries or investment grade corporates with that sort of 8-year duration like LQD. So oftentimes that is why when people ask me, how come investment grade corporates underperformed high yield bonds when people are worried about recession? Well, the answer is usually because if you look at the actual ETFs out there, they actually have those junk bond ETFs out there, HYG for example, actually have a very low duration. So they have lots of credit risk or significant credit risk, but less interest rate risk than a lot of the popular investment grade corporate ETFs like LQD have. Again, not a name I recommend, or certainly a lot lower interest rate risk than, say, the TLT, that long-term U.S. Treasury bond ETF. So let's circle back around. So given all that, I explained, how Fallen Angels ETF has offered, or Fallen Angels as an investment category have offered higher returns than the broader high yield bond market since the end of 2022. They offer much higher yields than dividend-paying stocks, since the end of 2022, much less risk than dividend-paying stocks since the end of 2022 on a standard deviation, annualized standard deviation basis. But I also explained how they do have a little higher duration risk than, say, that straight up HYG junk bond ETF, though lower than, say, the LQD investment grade corporate bond ETF or that TLT or IEF ETF that track treasuries. So why do I like, given that risk, that duration risk, why do I like the Fallen Angels as a long-term investment holding rather than the straight high yield bonds ETFs like HYG? Well, let me explain that in the simplest terms possible. This chart shows the credit quality of the FALN ETF, the Fallen Angels ETF, versus that HYG high yield ETF. And so what we're looking at here is the percentage of each ETF's portfolio in these different credit rating brackets. So both of these ETFs have very little exposure to investment grade credit. Sometimes these ETFs hold treasuries as a short-term place to park their cash, so that would show up as an investment grade credit. Sometimes they'll own a bond issued by a company that's rated junk, but it gets upgraded, and therefore they'll hold that temporarily, very short-term basis. They'll continue to hold that investment grade bond, but obviously both of these ETFs focus on high yield or junk bond credit, so they don't own much investment grade. However, you can see that Fallen has a little over 76% of the portfolio is in the highest junk bond credit bracket, which is that BB category. Anything rated BBB or higher is going to be investment grade. Anything related below that is going to be high yield. But the highest credit quality within high yield would be that BB credit quality. And so 76% of the Fallen portfolio is in that credit quality. It only has right around 12 or 13% in that next category down, which is the single B, and it has less than 10% in the below B credit rating. So those are the much riskier credits. In contrast, the overall high yield bond market, ETF HYG, has a little over 50% in BB, but it has significantly more, almost a third of the portfolio invested in B, and a little bit more invested in below B. So generally speaking, the FALN portfolio is higher credit quality than the HYG portfolio. So it has less credit risk. And if you think about it, it makes a ton of sense, right? Fallen Angels ETFs are companies previously rated investment grade that have been downgraded to high yield. There would be bonds issued by those companies. Mostly when a company is downgraded from investment grade to high yield, it gets downgraded from investment grade to the highest brackets of high yield. So most of the portfolio is going to be in that range. The least credit risky high yield bonds you could buy, basically. So, what does that translate? Well, in the long run, over the long term, what we found is that Fallen Angels ETF, or that Fallen Angels subset of the high yield bond market, is something of a sweet spot. It offers higher total returns with equivalent risk level to the high yield bond market and volatility in terms of volatility. So these bonds outperform straight high yield bonds through the cycle. Now there can be periods of some underperformance, right? Even prolonged periods of a few quarters of underperformance of FALN versus an ETF like HYG, but over the long haul, that hasn't been the case. Oftentimes when it is the case, lately it's been because of duration risk, right? FALN has slightly more interest rate risk than HYG, so if rates rise very rapidly, you can actually see FALN underperform slightly. The other thing is that when in the early stages of an economic recovery, or when investors have become less concerned about the health of the U.S. economy over a short period of time, say we have a growth scare, such as we saw back in late 2018, you'll often see the high yield bonds outperform the Fallen Angels because remember, those Fallen Angels bonds are near investment grade the majority of them, 76% of the portfolio, is near investment grade, whereas those that HYG ETF has a lot lower credit quality. So when concerns about recession recede rapidly, usually those lower credit quality bonds are going to rise a lot very quickly because of those rapidly receding credit risks. So early in an economic recovery, I would tend to favor, on a short to intermediate term basis, an ETF like HYG over FALN, but through the cycle, FALN wins. And let me show you this chart. Now, the FALN ETF was first listed for trading back in June 2016. I actually just took this back to July 14th, 2016, because I'm recording this on July 14th, 2025. So I thought that was just to give you an exact return over that time frame, almost the entire trading history of the FALN ETF. That first few weeks didn't have a lot of trading volume, so I think basing it from the middle of July also makes sense from that perspective. The HYG ETF has been around a little longer than FALN, so I measure the total return, again, capital gains and distributions, since July 14th, 2016 rather, all the way up through July 11th of 2025. And what you can see over this time period, as you can see on this chart, the FALN ETF is up 69.95%. The HYG ETF is only up 49.30%. That's a 6.1% annualized return for the Fallen Angels ETF, and only a 4.56% annualized return from the straight high yield bond ETF. So returns have been much higher over this time frame. Similarly, over this time frame, the standard deviation of the Fallen Angels ETF has been 9.2% compared to the HYG ETF at 8.6%. So that high yield bond ETF actually has offered a little lower standard deviation over this entire time period, but I can tell you that's only because of what happened in 2022 when interest rate risk was front and center like it hasn't been since the 70s or early 80s. So that was an unusual circumstance. But similar annualized volatility, much higher returns from FALN over time. And I would point out that since the summer of 2016, we've seen all sorts of different economic and market environments. We've seen bull markets in the S&P 500. We've seen nasty sell-offs in bear markets, two of them over this time frame. We've seen nasty sell-offs that didn't quite meet that bear market threshold in the S&P 500, like late 2018. We've seen periods of rising interest rates, falling interest rates, and everything in between, flat interest rates and everything in between. Yet over that whole cycle, and we've seen several cycles really over this time period, this is a period of 9 years roughly, we've seen the Fallen Angels ETF outperform the high yield ETF. So as I said, on a short-term basis, in a product like, in a service like Smart Bonds, I might choose to add a straight high yield ETF like HYG in the early stages of an economic recovery from recession or from a major soft patch for the U.S. economy. But from a long-term holding perspective, you're better off, I think, in that FALN ETF, the Fallen Angels segment of the high yield market. You get higher yields than you can get from dividend-paying stocks, similar yields to what you can get out of the straight high yield bond market. You get lower credit risk, right? You get similar levels of volatility and much higher returns historically. So I hope that helps explain the why for Fallen Angels, the why for high yield bonds. Hope that answers some of your questions. If you have any more, simply drop me a comment and I'll try to record another video covering some of those questions. Also, if you have any follow-up questions, I might be able to answer them directly in the comments below. If you're a free reader of the Smart Bond service and you're interested in seeing our model portfolio, which has beaten the aggregate bond index by a considerable margin year to date here in 2025, and it's up more than 7% annualized so far in 2025. If you'd like to see that, we also have a special summer offer to give Smart Bonds a try. Simply click the link below this video. Hope you found that useful. Again, my name's Elliot Yu. I'm editor and founder of Smart Bonds.